This is a new weekly outlook. As always, let's start off with the fundamental side and then move on to the technical side. Starting off with the macro fundamentals and Powell's message at the Jackson Hole Symposium on Friday, he opened the door to a September rate cut, which is his clearest signal yet after 8 months of holding the rate steady. But he emphasized that the Fed is stuck between two fires. Number one, inflation still sticky. Tariffs are keeping consumer prices elevated, especially via supply chain and import cost. And he said that the consumer prices are going to remain elevated in the coming months as well. Core PCE is running at 2.9% year-over-year rate, which is the fastest pace in 5 months. Number two, labor market is cooling. The economic data shows that the hiring has slowed down, jobless claims are rising, and labor market participation is overall dropping. Powell admitted that the job market weakness is now a bigger risk than before. The Fed is no longer quote-unquote inflation only. They're acknowledging growth and job risk, which makes a cut possible. While Powell is leaning dovish and cut-friendly, not everyone at the Fed agrees. The July FOMC meeting minutes showed us that some governors still think inflation is a bigger risk than job risk, and they're leaning hawkish against these cuts. Others fear a hard landing if the Fed stays tight too long, and they're leaning dovish and want these cuts. So going into September, we're expecting more dissenting votes, which is going to create market volatility since traders can't price cuts with 100% certainty. On Friday, Powell also officially scrapped the 2020 makeup strategy, where the Fed allowed inflation to run above 2% after undershooting. He also tweaked the definition of maximum employment. The old framework in 2020 was focused only on the shortfalls, for example, taking action if unemployment was too high. This new framework in 2025 has a more balanced approach. They will also act if the labor market runs too hot or too cold. This allows the Fed to have more flexibility. They're signaling they'll cut when jobs weaken, even if inflation is a bit high. The political pressure remains on the Fed's independence as Trump escalated attacks on Fed Governor Lisa Cook over the mortgage fraud allegations and threatened to fire her. Institutions are watching very carefully right now because if the Fed bends to political pressure, that undermines the independence premium of the dollar. For now, Powell got a standing ovation from global bankers for defending that independence. In addition to that, investors are increasingly leaning on private data sources now, like ADP, ISM, and S&P Global, and that's exactly what we're going to do as well, as the trust in this BLS data is now coming into question after Trump fired the head. Overall, we see that the Fed is boxed in. Inflation is still above target, but growth and jobs are slowing down. Powell hinted at a September cut, but Fed officials remain divided, and some even argued that inflation risk is still too high. During the speech, we also saw a very volatile bond market reaction. Powell's dovish tone triggered a sharp steepening of the yield curve. The front end 2-year yields dropped almost by 10 basis points. The long end stayed sticky, reflecting uncertainty about inflation being contained. Right now, traders have priced an 80% chance of a September cut and 2 cuts by year end. But institutions are still cautious of cutting rates into a tariff-driven inflation. Now, talking about tariffs and the trade tensions, we have the US and the EU deal, which outlines auto tariffs falling from 27.5% to 15% once the EU delivers reciprocal cuts on US goods. Metals like steel and aluminum may also move to a quota system instead of the current 50% duty. Japan and South Korea, meanwhile, are still stuck at the 25% auto tariffs despite the handshake deals, and losses are now starting to mount. Nissan reports 100 million yen per hour in cost, and Hyundai and Kia face up to $5 billion in added cost this year. UK Steel still faces the 25% tariff, despite earlier promises of relief. Lobbyists warned some producers could go out of business by year end if these cuts aren't implemented. The bigger picture here is that tariffs are not just headline noise. They are directly raising consumer cost, squeezing corporate margins, and fueling stagflation fears. When we're looking at the US consumers and retailers, we're also seeing that they're also under pressure. Walmart raised sales guidance, but its CEO admitted higher costs are filtering in as new inventory is hitting the shelves at post-tariff price levels. Home Depot and Target said they've delayed passing on the cost to the consumers, but the Q3 and Q4 prices will climb. Wells Fargo economists warn that consumer inflation will strengthen into 2025, leaving less discretionary income for the holidays. So right now we see that the US consumer resilience is intact for now, but sentiment could crack as tariffs and higher inflation fully hit the shelves in the coming months. Now let's take a look at the economic data that we're looking at this week. We're starting off quite easy. As you can see, a lot of orange and yellow folders. Red folders don't really kick in until Tuesday in New York session with BOC governor speaking. So in the beginning of the week, there are a few data points that we still want to be watching out for. For example, going into tomorrow's Asian session, you have the BOJ core CPI year over year. That's one thing that we definitely want to be watching out for. On Tuesday, we have the durable good orders coming out, and then starting off with the FOMC member Barkin also speaking, another thing that we want to watch out for. Then continue down into later into New York session, we have the consumer confidence coming out. We're expecting a bit of a drop compared to the 97.2%. So another data point, which is mid-impact, but we still want to watch out for going into September to really understand what's the full economic picture that we're looking at before these rate cuts come, and then what are we expecting going to the year end. Then Tuesday's Asian session, we have CPI coming out from Australia. So if you're trading the Australian dollar, that is one thing that you want to be watching out for. Wednesday is going to be quite easy. Another FOMC member, Barkin, speaking again in New York session. Thursday is when things pick up a little bit. You have the prelim GDP coming out from the US in the New York session. There's 3 GDP data that come out: advanced, prelim, and final. Advanced and prelim tend to have the most impact. They're red folders. So that's going to be very important to watch out for. And then unemployment claims, which comes out every single Thursday. But this is going to be very helpful going into NFP week. We're expecting that the unemployment claims are going to drop, but sometimes this number is revised as we get closer to the actual day. Then in Asian session, you have the Tokyo core CPI coming out from Japan, another thing to watch out for, especially if you're trading the yen. Then Friday, we have core PCE price index coming out, which is the Fed's most favorite tool or most favorite data point to watch out for. So we're going to be watching for the same exact thing. Now let's go ahead and move on to the technical side. So we're going to start off with US 30 first. When it comes to equities in general, before we start on the technical side here, I want you guys to understand what's the key difference between US 30 and NAS 100. US 30 includes pretty much auto, steel, manufacturing, a lot of different industries which are very tariff sensitive right now, and the big box retailers which dominate the Dow, versus NAS 100 is mostly tech, which is less sensitive to these tariffs at the moment, but it's still very rate sensitive. So the fundamentals are going to be pretty much the same when it comes to higher time frame and longer term equities. But understanding when you're looking for scalps or you're looking for day trades, when earnings come out, especially from tech companies, NAS 100 is going to be a lot more sensitive than Dow or US 30 is going to be. So those are some of the key differences. But overall, when it comes to market sentiment and fundamental analysis, it's pretty much going to be the same thing for both pairs. Now looking at US 30, let's start off with the weekly time frame. We have broken past this all-time high at 45,000. Right there. And then last week, we made a bit of a top wick at 45, let's say 800. And we can adjust this as we drop down to lower time frames. So I'm using the monthly, the weekly, and the daily to figure out what are my swing trade opportunities, if there are any. So in this current market condition, we're going to be extra careful before looking for any sort of swing trade opportunities, because Friday's push, that last daily push right here, happened because of Powell's speech and the expectation that we're seeing a rate cut. But as we're breaking these all-time highs and there's really nothing to reference to the left, we're really just playing based off of the fundamentals and the market sentiment to see if we can keep pushing. But right now we are still being very cautious, given that, the market economic conditions are still very uncertain, and there's a lot more uncertainty that's kicking in, given the geopolitical tensions, given the Fed's division on potential rate cuts and how many we're going to see and what the percentages are going to be. And then we also have the trade deals and tariffs and all that stuff, that's still playing out. So that's why we need to be extra careful when we're looking for our longer term opportunities. But as we drop from the daily down to 4 hour, 1 hour, 30 minute, 15 minute, all those time frames are giving you pretty good opportunities for your scalps and day trade opportunities. So looking at the daily time frame, last daily candle, nice top wick rejection, and then the new one just started forming. We come on to the 4 hour time frame. We can adjust this a little bit lower. So around 800 area ballpark is what we're looking at, but let's just say 770, I guess, here. And then we have this new 4 hour candle. So last 4 hour candle on Friday closed bearish. This new one had a bit of a gap up. The way that you can tell that is that this is where the previous 4 hour candle closed. And then we had a gap up here with this new 4 hour candle pushing back down, filling in that gap, which is going to be more apparent as you come onto the hourly time frame and even lower. So here on Friday, this is where we closed out with a bullish candle closure. And then this next one on the hourly time frame pushed back up. This is where the candle opened up and we're pushing back down. So when we're looking at any sort of potential scalp opportunities, we're not going to entertain anything basically until New York session tomorrow on Monday, and then after that. So here we still have a gap that the market has to fill. And this was when Powell's speech came out and we got that massive push up. After that one push up on the hourly time frame, the market kind of slowed down here a bit. And then we're looking for a corrective move of this entire bullish momentum. From a healthy technical perspective, any sort of push, whether it's bullish or bearish, when you're seeing massive pushes, those always have to be corrected. And the market's going to collect orders in two ways, either consolidation or correction. So here, either if we're going to see those continued bullish momentum and that optimism kicking in from a market sentiment perspective, then we can just see a consolidation here and then finally a push when more data comes out, when that optimism kicks in at the market open. Or we are going to see a little bit of consolidation and then a dip back down closer to that 45,000 mark to fill in this gap, and then that continuation back up if that optimism kicks in after a corrective move here. When you come onto a 30-minute time frame, same thing, you start to see that consolidation. So really no buying opportunities unless price can break above these previous highs. And from that point on, our game plan in SharmaFX is going to be start with a 1-to-1. Once price gets closer to that 1-to-1 and you're able to test the volume from a price action perspective, and you see that there's a lot more bullish volume kicking in, then you increase that 1-to-1 to 2-to-1 and you manage your stop loss. Either you move to break even, you decrease it, you trail it, whatever, take partials, all that good stuff, which we are going to be doing in our live sessions throughout the week. You do that. And then if you see that the volume is dying down, then you understand what's the limitation of your trade, which is going to be that 1-to-1. If price breaks back below this support zone, then we're looking for our selling opportunities and then targeting around 45,100 area for that gap fill. And then looking at if we see more of a risk off sentiment kicking in into the markets, then a deeper pullback below that 45,000 mark. Let's go over to GBP USD and start off with the weekly time frame. With GBP USD, we see that overall with the dollar index in general, we're seeing that the institutional flows are still long US dollar. The sticky inflation plus the tariff-driven stagflation risk is keeping that US dollar strength, and the US dollar will stay king here basically. And then when we're looking at GBP USD or Euro USD very specifically, we have a lot of data that's coming out from the Euro and GBP this week. And then plus the core PCE price index that's going to come out on Friday, that's really going to help move these pairs for longer term trade opportunities. And then of course, we're watching the headlines for any FOMC statements. We're watching for the tariff and the trade deals also. So all of that's going to be very important data points. So same thing with US 30 coming into GBP USD. We don't really have any long-term swing trade opportunities just set up just yet until price can break past these weekly, daily, and monthly levels. So when we're looking at the weekly time frame, I'm marking off the previous candle body open of the weekly candle, which is 1.356. And again, you can adjust that as you drop down to lower time frames. Instead of marking off that bottom wick rejection, what I'm going to mark off is going to be this little support area of this consolidation. So this is the range that we're trading in this week. And then if price breaks below that, then we're targeting the bottom wick right here and a continuation back down. And that would mean that the pound is weakening against the dollar and the dollar is just gaining more strength. So that would help push GBP USD back down bearish. If we are starting to see that GBP USD or both currencies in general, there's not one really gaining a lot more strength versus the other, we're going to sit in this consolidation like we have here in the past. in May 2025, all of May 2025, and even going into mid-June. Let's come on to the daily time frame. So you start to see that consolidation a lot more clearly. We kind of hold on to this area of support. We try to break below it, but then we come right back above it. And then same thing here. So if you wanted to adjust that level, that's that bottom wick rejection from the weekly time frame. I'm going to mark it and keep it right at this level since this was a previous resistance. Support, break and retest support, and then right here as well, break and retest resistance before it push back up. So if we're going to look for any sort of selling opportunities, the first area that I'm going to target is going to be that 1.345 area. And same thing here as US 30, there's another gap that happened here. On US 30, it was a gap up. Here on GBP USD, we have a gap down, which gives us more confirmations of that US dollar strength, right? And the US dollar king right now. So when we're looking at the previous daily candle on Friday, we closed bullish right here, which is that previous consolidation area right here. And that consolidation becomes more clear as we come on to the 4-hour time frame right here with these 4-hour candles that just closed side by side. So we rejected right into that 4-hour time frame. Last 4-hour candle closed with a weak bullish candle closure. This new one started forming. So this is where that previous 4-hour candle closed. This is where the new one started forming. We filled in that gap with the top wick rejection and we're pushing back down bearish. If I'm looking for any selling opportunities, whether it's a day trade, scalp, anything like that, I want price to keep breaking below this zone, continue to the downside. The first area that I'm going to be targeting here is going to be this previous support, which is that wick fill right here as well. 20 pips and then a continuation down further into this previous resistance, 40 pips, and then that overall range that we're looking at is a 60 pip sell opportunity to come back down to 1.345. If price holds onto a support in this overall range here and then pushes back up bullish, then we're looking for a bit of a corrective move potentially down here and then a push back up, and you're looking at a range of about 60 pips to the upside as well. Come down to the hourly time frame. So this new candle just started forming, and neither the London session or the New York session have been open yet. It's just the Asian session. So we're going to wait until London session opens up and then also New York session opens up, and then we're going to see that volume here. Well, same thing on Friday, we got that massive push up here at the speech, and then we're expecting to see a corrective move of this entire bullish pushback down. Euro USD tends to be the same exact market structure as GBP USD most of the time, sometimes kind of just lagging behind it. When we're looking at the weekly time frame, last weekly candle closed weak bullish. And then I'm going to mark off this support area right here with these bottom wick rejections at 1.159. Come on to the daily time frame. The daily candle is currently bearish here, starting to push back down. If I'm going to look for any selling opportunities, I want price to clear below all of these wicks here, just to make sure that we're not getting stuck in any sort of consolidation. If you're looking for a scalp, you do have a range of about 30 pips or so. But for a longer term, let's say scalp turned into a day trade, then I'm looking for around 30 pips and then a continuation back down. For 80 pips, you almost have a 95 pip range here, coming back down from below this zone to 1.159. Come on to the 4-hour time frame. You got that massive push up here on Friday at New York Stock Exchange Open, and then also with Powell's speech. And then after that, we got a nice little push up, came back down, closed bearish. This is where the previous 4-hour candle closed. This new one started opening with a gap up, same thing, got a top wick and then pushing back down. Anything in between, I would not be trading this, given that it's just Asian session right now. So we're still waiting for London and we're waiting for the New York session. And we know that GBP is probably not going to move a lot in the London session, given that it's a bank holiday. So we're probably seeing more movement on Euro USD instead of GBP USD. For any buying opportunities, we want price to break above that 1.172. Hold on to a strong support here and then continue to the upside. If that happens, then we're just hopping up to higher time frames and then targeting these previous highs. So if price holds on to a support here and then pushes back up, you got a wick fill for about 20 pips or so, and then a continuation up for about 50 pips. And then same thing, you take it from 1 to 1, 2 to 1, 3 to 1, and all that stuff as you continue to see that volume kicking into the market. Now looking at GBP/JPY, here we have the current weekly candle, that gap down after that previous weekly candle right here, 198.5. And then I'm going to mark off the previous weekly candle open, which is 199.5. So that overall is a 100 pip range that we're looking at. Let's come on to the daily time frame, sitting into exact consolidation here, even on the daily time frame. So that's why we need to be extra careful. Anytime price has tapped into this, we see that bullish momentum to the upside. And then same thing here as well, came back, closed bearish, and then you got that bullish momentum to the upside. And then same thing here. We don't really get that bearish candle closure or a continuation back down until we get those actual pushes back down here. So we need to see that there's enough fundamentals to support this entire pushback down. If that happens, that basically means that we're looking at the Japanese yen gaining more strength against the pound. And that can happen either with the currency itself gaining more strength as the more economic data comes out, like CPI, BOJ CPI, or Tokyo CPI that's going to be coming out this week. Or if we just start to see more safe haven flows because of the geopolitical tensions, the uncertainty, and all that stuff kicking in. Now looking at the daily time frame, another level I'm going to mark off, which is going to serve as my first target area. It's going to be, let's just call it 199. So that gives me about 50 pip range from zone to zone. So you got 50 pips and then another 50 to the upside. This is where the previous 4-hour candle closed bullish, and then today's made a bottom wick, opened up right here, and then we're looking for that continuation to the upside. Come on to the 1-hour time frame. So we just want to see price holding on to a strong support here and then push back up. Same thing, correct that entire bearish move down, at least to a 50% mark of 199. So this is going to be a very crucial point. This is where we're going to figure out if we're looking for those selling opportunities after a corrective move of the seller's pressure to the downside and come back for another 50 pips to 198.5. Or if we're able to break above that, hold on to a support, then you got 50 pips to the upside at 199.5. Euro or USD JPY. Starting off with the weekly, we're holding on to a support at 146.9. Here, as you can see, it's a bit of a consolidation, but we still have that bearish pressure kicking in. So I'm going to hold on to this next resistance right up top here with this bullish candle closure, which is the last bullish candle that we have seen on the weekly time frame as of right now. So I'm going to keep it at that same exact level. If I look to the left, that is a support resistance. And then if I look further to the left, then I need to see more confirmations, which here seems like it's a resistance. So right now on the weekly time frame, it seems like we had a bit of a consolidation, a push back up, and this seems like a corrective move, but still within consolidation, where we don't have clear direction where price is headed. When we drop down to the daily time frame, we see that clear consolidation here. So this is a zone to zone trade example where you're understanding the limitation of your trade is pretty much coming back for about 80 pips, 90 pips into 147.76 or even 148 flat, any of that. Drop down to the 4-hour time frame. It seems like we're holding on to a support, pushing back up bullish. So if we're looking for any buying opportunities, we want to make sure that price can clear above this previous 4-hour support and then correct this bullish momentum to the upside. The first target being 147.76 and then a continuation back up to these previous highs that price has made. Let's come over to gold. Gold on a weekly time frame, that's a very tight consolidation, but still maintaining that bullish structure to the upside as price continues to create these new higher lows at each of these points. So that tells you that there's still a lot of bullish pressure here, and that also comes from the geopolitical tensions, the uncertainty, the trade deals, the tariffs, and all that stuff. So looking at the weekly time frame, I'm going to mark off the support right here, which is, just say that. And then I'm going to mark off the previous top wick rejection of the previous weekly candle. Right there. Now you come on to the daily time frame, and on the daily time frame, you see a ton of consolidation right into this area as well. Overall, this entire zone is consolidation, but what we're trying to do is narrow in our consolidation even more. So here we see that price, gives us a lot of fake outs, all that good stuff. But ultimately, we do end up holding on to a support at this level and then push back up bullish to come back and tap into this previous area of 3379.6, 3380, anything like that. We drop down to the 4-hour time frame. We come back up, we reject right into that area. So for any selling opportunities, we're looking for price to break below the support and then continue back down bearish. Massive push up again with Powell's speech at the Jackson Hole Symposium. And then after tapping into that previous high of 3379.6, the last 4-hour candle again slowed down in volume. And that's the same exact pattern that we have seen across all the pairs that we just analyzed, right? And then we had a bullish candle closure here. This new candle made a bit of a top wick. We have yet to fill in this gap up top here too, and then push back down bearish. So either we hold on to a support here, and then we're looking for our buying opportunities to come back into 3379.6, or price continues pushing back down and then ultimately correcting this entire seller's or buyer's pressure to the downside. So here, same thing, you got that gap that the market has yet to fill. So we're going to look for a corrective move and then potentially hold on to a support somewhere halfway through and then push back up. So that was a lot of bullish momentum, no bottom wick here, as you can tell. So that was a massive, massive push up that the market has yet to correct. And again, the market's only going to collect orders in two ways, consolidation or retracements. So we got a ton of macro fundamentals that we're watching out for. We're watching out for the headlines. We got a ton of economic data coming out this week as well and preparing us for the NFP week and then even preparing for September potential rate cuts. So this week, the theme is divergence and being cautious with your trades, with your risk on versus risk off sentiment, and the understanding that the volatility is likely to return as we head into September. So don't chase the highs. Wait for the market sentiment to align with your data. Wait for the actual data release. Watch for the headlines. Watch for any FOMC statements that are coming out. And if you want to learn how to trade these fundamentals and market sentiment driven shifts with precision, then check out the SharmaFX blueprint and the mentorship at sharmafx.com.